Thank you, and kia ora koutou. Good morning, everyone, and it's a real pleasure to be here this morning. I wanted to congratulate the Waikato Management School for organising this forum. It really is becoming an important fixture in the New Zealand economic and political landscape. It was great to hear from Adrian on monetary policy, and I'm going to talk about its friend, fiscal policy. I'd like to focus on a quintessential challenge for any Treasury, which is how to ensure that fiscal policy is effective, stabilising and sustainable. The timing of this is apt. We recently released the Treasury's briefing to the incoming Minister, or BIM, that we provided to our new Minister of Finance, the Honourable Nicola Willis, who I know you had the pleasure of hearing from yesterday. And so, reflecting the advice contained within our BIM, I want to speak today about the changing fiscal realities that policymakers are faced with, why Treasury believes that a period of fiscal tightening is required now, and I'm also going to discuss our fiscal institutions and how they could evolve to meet some of our immediate and also longer term challenges. So just a bit of scene setting. New Zealand is, as you know, highly regarded internationally for the quality of its public finance institutions, which emphasise transparency, accountability and medium-term sustainability. The Public Finance Act of 1989 and the Fiscal Responsibility Act of 1994 and all the rules that support them set a benchmark for fiscal management. Since their inception 30-odd years ago, these have enabled governments to prudently manage finances and support the economy to improve the lives of New Zealanders now and into the future. And successive governments have undertaken some really significant fiscal repair following a large build-up of debt in the 70s and the 80s. Net debt, as you can see here, was managed down from around 50% of GDP in 1991-92 to around zero in 2007-2008. So that's equivalent to about negative 5% on our current net debt measure. Gross debt had peaked at over 70% of GDP in 1987. So these lower levels of government debt and a stronger Crown balance sheet enabled governments to provide support to the economy through some pretty large economic shocks and natural disasters, while still maintaining a sound position. Lower debt also lowers the risk premium in interest rates and supporting higher living standards. But even just this chart also points to some emerging challenges for fiscal policy in New Zealand. The policy responses to the global financial crisis, Canterbury earthquakes, and especially now the pandemic, have led to a rise in public debt. Now, in and of itself, that's not necessarily a concern, since the level of debt in New Zealand is still relatively low, and we at Treasury consider that current levels remain prudent. But the bigger concern is that the trajectory of the debt is rising, and operating expenditure has continued to exceed revenue on an ongoing basis. This was the case even through a period in which the economy was overheating and employment was at generational lows, which is normally a time when we expect fiscal policy to be at its tightest. Fiscal policy has been tightening, but not rapidly enough for fiscal policy to make its optimal contribution to stabilising the macroeconomy. And so the first part of my remarks today are going to focus on that stabilisation role. Second, I want to speak about the sustainability of fiscal policy. As New Zealand is running deficits throughout the economic cycle, the country is now best described as having a structural fiscal deficit. Now, that's going to prove unsustainable unless change is made, and there's change that's outlined in the Treasury's current forecast of a return to surplus. Structural deficits increase vulnerability to the fiscal impacts of natural disasters and other economic shocks. They increase debt servicing costs and they shift costs to future generations and ultimately reduce government's ability to provide public services. Running sustainable fiscal policy imposes constraints on revenue and on spending. The third part of my speech will talk about the structure of fiscal policy, how governments can get the best value from their limited resources in order to lift living standards and achieve their priorities. The final part of my speech will outline how we can strengthen the fiscal institutions that have served New Zealand well for the past few decades. Doing so will help to promote transparency, accountability and performance of government. But I would add just a cautionary note. Although strengthening our institutions is important and will make a difference, doing so alone is not going to solve our challenges. New Zealanders and the representatives we elect to make decisions on our behalf do have some tough decisions and some big trade-offs to make in the coming years on what we value, what we want to prioritise, and by implication, what we attach less value to. So first, let me turn to fiscal policy and its contribution to stabilising the economy. Generally, macroeconomic stabilisation is best achieved through monetary policy. We just heard from Adrian about that, rather than fiscal policy, which involves government decisions on spending and taxation. Early in the COVID-19 pandemic, however, it was clear that a monetary policy response alone would not be sufficient to confront the scale and the nature of the shock, especially with the OCR already near its effective lower bound. Fiscal policy played a critical role in the resilience of the economy through the pandemic. And we saw, one of the big lessons was just we saw how quickly and effectively fiscal policy could be deployed to target needs. The wage subsidy, other economic supports helped to keep people in jobs, helped to keep businesses running. Funding enabled an effective health response, and increases to benefits, other welfare spend helped to support some vulnerable people. The size of the fiscal response was unprecedented, with both the deficit and debt increasing sharply. The accounts moved from a surplus of 2.4% of GDP in 2019 to a deficit of 7.3% of GDP in 2020. Now, Treasury's fiscal policy advice at this time emphasised that an effective fiscal stimulus is one that is temporary, targeted and timely. While fiscal policy supported a strong recovery from the pandemic, we also experienced some of its limitations. Following the initial shock from the pandemic, the New Zealand economy recovered very rapidly. During 2021, annual GDP growth peaked at over 6%, house price inflation peaked at over 30% per annum. By 2022, the unemployment rate had fallen to record lows, 3.2%. And the resulting inflationary pressure was compounded by restrictions on supply imposed by Russia's invasion of Ukraine, global shortage of shipping capacity, and then, of course, the effects of Cyclone Gabrielle and the floods. CPI inflation increased to 7.3% mid-2022, and those imbalances were also reflected in the current account deficit, which widened to 8.8% of GDP in December 2022. And so over this period, we're reminded that fiscal policy is typically easier to loosen in a downturn than it is to tighten in an upturn. Unlike monetary policy, fiscal policy often involves programs where spending is spread over many years and is therefore hard to reverse. Events of the day typically put governments under renewed pressure to spend rather than to consolidate. At the Treasury, our assessment is that about a third of the increase in inflation following the pandemic could be attributed to demand factors, a third to supply constraints, and the attribution of the final third is uncertain. While that final third and the breakdown of demand is uncertain, our assessment is that fiscal policy has had an impact on inflation. Our general rule of thumb, based on international and domestic evidence, is that additional fiscal stimulus equivalent to 1% of GDP would cause the OCR to rise by an additional 30 basis points. It's very much a rule of thumb. There's a wide range of estimates in the literature. The nature of the shock matters, of course, as does the specific form of any fiscal stimulus or contraction, and there's great variation within different types or categories of fiscal stimulus, so it's just a rule of thumb. Attributing interest rate increases to fiscal stimulus is further complicated by the up and down nature of spending and taxation through the pandemic, as illustrated in the Treasury's estimate of the fiscal impulse, which measures the impact of fiscal policy on aggregate demand compared to the previous year. Some years, fiscal policy was subtracting from demand pressures in the economy, in part because of the temporary support measures that came to an end. But all up, our assessment is that fiscal policy has contributed to interest rates being higher than otherwise. It's not the main driver, but it certainly was a factor among many other factors. Although the economy is expected to slow in the next 2 years, our assessment of current macroeconomic pressures and the fact that the current fiscal deficit is structural meant that in our BIM, we recommended that government should prioritise a return to a surplus. This is going to require substantial fiscal consolidation to bring revenue and expenses back into balance. Doing so will support fiscal sustainability, which I'll discuss shortly, and importantly, it will support monetary policy to bring inflation back into the target range. Higher government savings is also going to contribute to narrowing the current account deficit. Recent Treasury economic and fiscal updates, underpinned by Treasury's economic forecasts and the plans of the previous and current government, are consistent with this view. The forecasts assume an extended period of tight fiscal management that would see a substantial decline in real government consumption. And it's similar to size, just to emphasise it, it's similar to the decrease in the early 1990s, but over a shorter time frame. The asymmetry of fiscal policy, so the fact that it's easier to spend than to cut, reinforces why fiscal policy should be used judiciously in macroeconomic stabilisation. In part, this means having a clear understanding of the respective roles of monetary policy and fiscal policy in different scenarios, and also a really good common understanding across authorities of the policy toolkit to use the one that is best suited for the range of shocks that we expect. It also means recognising and acting on the strengths and the limitations of fiscal policy. For example, this may mean relying more on automatic stabilisers, such as payments and taxes linked to the economic cycle, or semi-automatic stabilisers. So the wage subsidy is a good example of a semi-automatic stabiliser, where funding is only released when certain conditions are met, in that case related to pandemic restrictions. And it may mean relying less on tools like increases in infrastructure and core government spending as a response to big downturns, because they come with really significant lags and they're quite difficult to withdraw after the fact. So we're currently investing a lot of time and effort in researching these questions in the Treasury as we prepare for the next inevitable shocks, and working with our colleagues in the Reserve Bank on how we might coordinate in a response. So I'm now going to turn to the question of long-run sustainability of fiscal policy. Between 2019 and 2023, the IMF estimates that the New Zealand government's net debt increased by 18% of GDP, compared with a 4% increase for the average advanced economy. So it was a really big stimulus. Despite this increase, Treasury does consider that the current level of debt is still prudent. We did extensive analysis on debt sustainability in 2022, and we concluded that even in a scenario of really high real interest rates and modest GDP growth, it would be technically possible to recover from debt levels near the average of IMF advanced economies, which is around 90% of GDP. Although, of course, much depends on the willingness of governments to run meaningful and significant surpluses after the response to large shocks. The sustainability of any given level of debt depends on a range of factors, but the most important are the interest rate on the debt and the growth rate of the economy. Higher economic growth allows a country to grow its way out of debt, while higher interest rates increase government expenses and make debt consolidation harder. The decade following the global financial crisis features steadily falling interest rates, which have improved the sustainability of government debt. However, interest rates have increased, as we all know, in recent years. Finance costs in the Crown accounts have increased from a low of $1.9 billion in 21 to $6.6 billion in 2023, and they're forecast to be $8.8 billion by the end of the forecast period. It's 2.1% of GDP. That's near the level of the late 1990s. So it's hard to disentangle how much of the interest rate increase is temporary and how much will prove lasting. But it's worth noting that estimates of neutral interest rates have risen. Treasury's estimates of where the New Zealand government 10-year bond yield will settle have only increased a little since 2022, but nonetheless, we expect interest rates to be higher than the ultra-low rates that prevailed pre-pandemic. Future GDP growth is, of course, difficult to predict, but between population ageing, climate change, global productivity slowdown, geopolitical fragmentation, prudence would suggest that we borrow only what we can afford to repay in a modest growth future. So we really should not be relying on favourable debt dynamics that we've had going forward. Over the long run, fiscal sustainability depends not just on today's debt level, but on the trajectory of debt over time. And it's here where we see New Zealand as facing greater challenges. New Zealand publishes a long-term fiscal statement every 4 years, assessing a fiscal outlook over a period of at least 40 years ahead, outlining possible trends in spending, in revenue, the operating balance and debt. The last statement illustrated that at historical policy settings, our core Crown expenditure will significantly outpace revenue over coming decades. New Zealanders are, on average, living longer and healthier lives, and that's a great thing. But combined with ongoing increases in health spending and superannuation, it's likely to put a lot of pressure on public finances over the longer term. The statement highlights that a package of measures would be necessary over time to stabilise net debt, but the balance of policy measures is largely a value judgment for governments. Looking forward to the next statement, which is due out next year, we're working on it now, many of the risks that we've outlined in past statements are starting to play out now. The ageing of the population, for example, is upon us now. Gross New Zealand superannuation benefits costs about $20 billion last year, and if you exclude budget decisions, they're the fastest growing expense item across the forecast period, projected to rise to 7.7% of GDP by 2061. Health costs have risen 1.3 percentage points to 7.2% of GDP over the last few years, and they're also projected to rise to 10% of GDP by 2061. We've also recently experienced how climate change is likely to impose large fiscal and economic costs, as well as devastating human, environmental and social costs, both now and into the future. We estimate that the economic costs of Cyclone Gabrielle and the floods is somewhere between $9 and $14 billion. Government's allocated already $4.7 billion to the response to date, and insurance claims top some $3.5 billion. And as we know, these severe weather events are only going to get more frequent and worse. We're experiencing the best weather we're going to see in our lifetimes now. In addition to these long-standing issues, new challenges have risen in prominence. These include increasing geopolitical risks, which have implications for international connectedness, as well as national and economic security. It's already dampening economic growth prospects via deterioration in trade opportunities of the terms of trade. Government's finances could also be directly affected if a less secure world leads to more defence and security spending. So these challenges, ageing of the population, climate change, geopolitical fragmentation, they really illustrate that achieving sustainability in our public finances is going to require either tight control of expenditure growth, stronger revenue growth, or both. The ongoing nature of population change, climate change and shifting geopolitics implies that there will be a structural generational challenge. So that takes me to the structure of fiscal policy, the composition or allocation of government spending and taxation, and how that matters for productivity and overall living standards. There are often trade-offs in setting fiscal policy to achieve macroeconomic stability and sustainability goals on the one hand, and then also the desire to meet government objectives and to improve living standards. And in today's context, a faster consolidation will support monetary policy to bring down inflation and improve sustainability, but it may pose trade-offs with government services and priorities. And so that's a really key consideration in setting targets on the return to surplus. Our BIM highlights some recent trends in New Zealand's fiscal structure. The first point to note is that both government expenditure and government revenue have increased. In other words, government's now playing a bigger role in the economy than it used to. Core Crown expenditure averaged about 30% of GDP between 1994 and 2019, but it's now about 32%. And at the same time, Core Crown revenue has been rising as a percent of GDP from 28.4% in 2023 to around 30% estimated in the next 5 years. Now, as people here in this room would know, there's no consensus on the optimal size of government. There's a wide range within the OECD, for example. And similarly, the goals of fiscal policy involve value judgments that are best made by elected officials. Our emphasis in Treasury is on ensuring that government revenue and expenditure is efficient and effective at achieving the outcomes desired by government on behalf of society. The second point I want to make on the structure of spend is about the question, where has all the spending gone recently? I've already mentioned increases in superannuation and health spending relative to GDP. However, these areas are not the only ones in which spending has grown. Total fiscal position has also been influenced by rapid spending growth in a lot of smaller areas, such as early childhood, corrections, where they're taking an increasing share of the budget. Looking at the structure of spending by how it's administered, in recent years we also see that core government department spending has increased, but by far the biggest dollar growth has been in areas outside of core public sector departmental spending. That includes activities in areas like transport, housing, health and welfare. And importantly, these are areas where government has less direct levers for fiscal control, as most involve Crown entities, which operate with just that little bit more independence than core government departments. The growth in expenditure also raises important questions about how costs and benefits are balanced across different groups. So for example, this chart shows that relative to other welfare benefits, given its universal nature, New Zealand superannuation spending is widely distributed across different income groups. It's a significant source of government transfers for higher income New Zealanders. In contrast, average working age support, things like working for families payments, housing support, are more progressive. They decline steadily with increasing income deciles. As the population ages, under current policy settings, we can expect to see an increasing proportion of government transfers to higher income New Zealanders. Efficiency and value for money can and should contribute to fiscal sustainability. As Ernest Rutherford said, we don't have much money, so we're going to have to think, and government departments are now working very hard to identify efficiencies and productivity improvements. But even with this, hard distributional calls will be inevitable going forward because most expenditure goes to transfers and public services like health and education. At some point, we're going to have to decide as a country how to share the cost of fiscal sustainability between young, old and working age New Zealanders. There are also important trade-offs to be considered for government revenue. Personal income tax makes up 53% of New Zealand's revenue system. It's more than most other OECD countries. There are constraints on a personal tax system which are limiting the options for reform, most prominently the difference between our personal and our company tax rates and the lack of a capital gains tax. For example, differences in rates between company and personal tax limits the ability to raise revenue or reduce the company tax rate, as income can be sheltered in companies. The lack of a comprehensive capital gains tax increases the economic cost of income taxation, distorts the allocation of resources within the economy, and restricts the option to manage gaps between company and personal tax rates. Based on principles such as efficiency, sustainability and fairness, Treasury's long-standing and first best advice is to address these two structural issues in the tax system. Major tax changes, of course, take time to implement, so there's a need to plan for these early, and ultimately these are choices for elected officials. We'll have more to say on the long-term fiscal outlook in next year's long-term fiscal statement. So let me move on to the last topic I wanted to cover, which is strengthening fiscal institutions. To make those quality decisions that support fiscal stability, sustainability and the contribution of fiscal policy to living standards, and to understand the trade-offs between those goals, we need to ensure better demand, quality fiscal institutions. By institutions, I don't just mean organisations, I mean the laws, the regulations and the ways of working, the whole system that supports decision-making and understanding of public finances. So I'll give an example. Some have proposed an independent finance institution, or IFI, as a way to sharpen fiscal discipline accountability. But when we compare the features of IFIs across countries, the Public Finance Act already assigns many, importantly not all, IFI functions to existing parts in the New Zealand system. So for example, the Treasury is responsible for preparing forecasts and long-term fiscal projections independently to government. So without getting into the debate, it's an important debate to have, we take a broad view of reforming institutions, one that looks at the system as a whole and not just at the organisational level. Now, New Zealand's public finance system has great strengths, especially in promoting transparency and accountability, and we don't want to lose those. But it's widely agreed that there's room for improvement and a need to adapt to today's challenges. Treasury's BIM outlines what we're doing to embed some shifts in the public finance system. We're working towards a system that increasingly focuses on delivering on outcomes for New Zealanders and results, as well as managing the dollars, focusing more on long-term issues as well as annual budgets, deepening our consideration and understanding of public sector finances as a whole, not just the incremental annual budget spending, so the $140 billion of expenditure, not just the few $billion of new spending and allowances, and also focusing on more joined-up approaches across the public sector to deliver better results and break down those agency silos. Within those long-term goals, we're working on shifts to support those core principles underlying the Public Finance Act, transparency and accountability, with measures that can help government to best navigate the tighter fiscal environment ahead. Getting more value for money out of our expenditure will be critical to managing to expenditure targets and creating the fiscal headroom for future investment. So we're improving accountability by strengthening performance management systems, tightening the rules and enforcement around investment disciplines. We're helping to enhance transparency by expanding reporting to show where the dollars are going, beyond the current level of appropriations to reporting on programs and funds. It's a huge constraint to understanding where the dollars are going and what they're delivering. We're providing more information on risks in the fiscal outlook, undertaking spending and performance reviews of agencies to more actively manage risks and performance, and encourage continual reprioritisations to programs that work and grow the productive capacity of the economy. With new data, technology, better analytics, this is actually quite an exciting space for the Treasury. Our emphasis is on rigour and evidence and strong frameworks, including the Treasury's Living Standards framework, to help decision makers get a comprehensive view of the impact of the choices that they face, including over time and across a range of outcomes. So just to sum up, New Zealand has a strong track record over successive governments of maintaining sound public finances. This record and the supporting fiscal frameworks contribute to market and rating confidence in New Zealand's long-term fiscal sustainability and thereby supporting growth. We're not alone in facing fiscal challenges, and many countries are facing similar issues post-pandemic, and we're all pretty much facing those growing pressures associated with climate change, ageing populations and increasing geopolitical risks. In the near term, our frameworks have delivered a government balance sheet that has allowed governments to deal with some of the really large shocks that we've faced and minimise the negative impact on living standards. But I want to conclude today with a point that these challenges are not about the distant future. The long-term fiscal pressures that Treasury's been calling attention to for some time now are here now. And these challenges are being exacerbated by the structural deficit that has emerged in recent years. I'm really confident that we can meet these fiscal challenges, but doing so will require continued action over both the short and the long term. We're working at Treasury to build on the best of the public finance system that has served New Zealand so well, so it lifts our fiscal performance in the near term and continues to support governments to address those big complex challenges in the decades ahead. Thank you and kia ora.
Well, thank you so much, Caralee, for your keynote address. We've just got 1 or 2 minutes, so I'll just, we've got lots of questions that have come through. We're not going to have time for all of them, I'm sorry, but we have got a panel following. I wonder, Caralee, if you have any comment on the current labour market, recent migration numbers, and what this means for underlying fiscal pressures over the next 2 to 3 years.
Oh, thank you. Yes, and we're in the process now of updating our forecast for the budget that will be released at the end of May. And so examining all of these, the more recent data releases in some detail. And I guess we're seeing some opposing forces, really. On the one hand, we've had GDP turnouts coming a bit lower than expected, and that's obviously going to have implications for our revenue as well as our overall economic forecasts. On the other hand, we see quite a bit of strength, particularly coming through in migration, although there's quite a bit of volatility in migration data as well. And employment labour market data came out a little bit stronger than expected. So, there is still quite a bit of uncertainty and volatility in the data. We're seeing, different forces at play and taking all of that into account in our forecast. But look, overall, the big picture is that the economy is slowing and slowing really in line with what we have forecast to date. Demand is coming down closer to supply, and that's going to support lower inflation. So ups and downs at the margin, but the overall trend is clear.
Thanks. And just one more question that ties in very much to how you introduced your session following Adrian's address this morning. Is better coordination of monetary and fiscal policy any more complicated than an inflation target and adherence to fiscal responsibility principles? So is that coordination going to make life much more complicated than the two more separate targets?
I think that the coordination is going to make life a lot simpler, and we work really effectively with our colleagues across the road and are working hard to strengthen channels for coordinating fiscal and monetary policy. And I think it's possible to do so while respecting the very different channels of decision making Monetary policy, very importantly, needs to have independence in its decision making. It's the Monetary Policy Committee that is responsible for the operationalisation of monetary policy, and fiscal policy, of course, is the responsibility of elected officials. So we can respect those different channels and the independence that's built into the system, but at the same time make sure that there's good information sharing, a common understanding of different types of tools, so that we know that monetary policy and fiscal policy are ideally working in the same direction. We hopefully have a sense of the magnitude of the two together when we make our respective decisions, and also really importantly understanding whether we've got the right tools for the job. So we've got a number of really effective mechanisms. Treasury is an observer on the Monetary Policy Committee, effective mechanism for coordination. We've got some joint work in understanding housing markets, for example, so that we each have an idea of how decisions in one sphere can affect the likely necessary response in the other sphere. And we continue to have good exchanges at all levels of the organisation. But to the question, I think that's actually going to help simplify things and make for more effective responses to downturns and macroeconomic stabilisation in the future.
Well, thank you very much. That's a really positive note to end your address on. And it's been a real treat for us this morning, isn't it, to have leaders from both Reserve Bank and from the New Zealand Treasury joining us for these keynote addresses. So once again, thank you so much, Caralee, and we'll invite our next panellists to join us on the stage.